Welcome to Macro Money Talk, where we dissect the financial decisions that determine the difference between stagnation and massive global success. Let us start with a thinking question. Would you rather own 100% of a single, small, delicious pastry today? Or would you prefer owning just 10% of a massive bakery that produces thousands of fresh loaves every single day? This fundamental decision will ultimately define your level of control, the risks you face, and the wealth you might eventually build. It is the classic dilemma of business financing. Do you keep the whole pie small or share it to make it grow? To understand this game, we must look at the two main ways companies raise money to fuel their expansion and operations. These two primary vehicles are equity, which means selling ownership, and debt, which involves borrowing money that must be paid back. Let us first explore equity financing, the method most often glamorized by media and popular television shows like Shark Tank today. Equity financing is essentially selling a portion of your company to an investor in exchange for an immediate injection of cash. This is incredibly common for startups because they usually lack the revenue or physical assets required to secure a bank loan. In the early days, your idea is your only currency. You trade potential future value for the capital needed to survive now. Investors provide the fuel, but in return, they demand a seat at the table and a claim on your future profits. The main advantage here is that you get money without the pressure of monthly repayments, plus access to valuable investor networks. Think of the Shark Tank style. You get the capital and the mentorship, which can accelerate your business faster than a loan. However, the downside is significant. You are permanently giving away a slice of your creation, and that slice can become expensive. As you sell more equity, you dilute your ownership. Eventually, you might lose the ability to make decisions for your own company. The most famous example of this risk is Steve Jobs, who was ousted from Apple, the very company he founded, in 1985. Jobs had sold so much equity to raise funds that he no longer held the majority voting rights to save himself. When the board turned against him, he was powerless. He was fired from his own creation because he lost control of equity. The journey of equity usually happens in rounds. It starts with the seed round, where you turn an idea into a prototype. Next comes Series A. At this stage, you have a product and some customers, and you need money to prove the market. Then comes Series B. This is all about scaling up operations, hiring more staff, and expanding your reach to new customers. Series C follows for successful companies looking to dominate their industry, acquire competitors, or prepare for the final massive public exit. The ultimate goal for many is the IPO, or initial public offering, where the company is listed on the stock exchange. At an IPO, early investors cash out their stakes for massive returns, and the founders become wealthy, liquid, and public figures. Now, let us pivot to the second major method of financing: debt. This is simply borrowing money that you must repay. Surprisingly, over 90% of the companies in the S&P 500 use debt as their primary source of financing operations. Unlike equity, debt does not dilute your ownership. You retain full control of your company as long as you make payments. Let us look at Apple again. They sit on a cash pile of over $162 billion. Yet they still issue corporate bonds to borrow billions. Why would a company with so much cash choose to go into debt? The answer lies in the cost of capital. Borrowing money at low interest rates is often cheaper than using their own equity. Furthermore, interest payments on business debt are tax deductible. This creates a tax shield that saves the company millions of dollars. Debt allows companies to leverage their operations, fueling growth without giving up a single share of voting power or future profits. The trade-off is the obligation. You must pay the bank, regardless of whether your business is making a profit or not. If revenue drops and you cannot make payments, the lenders can force you into bankruptcy and seize your company's hard assets. Debt comes in various forms. There are traditional term loans, which work like a mortgage with fixed payments over a set time. There are lines of credit which act like a credit card for the business, smoothing out cash flow issues during slow months. And for massive corporations, there are corporate bonds. This is essentially borrowing directly from the public instead of from a bank. Finally, there is the third path, bootstrapping. This means building everything from scratch using your own savings and generated revenue. Bootstrapping is the path of self-reliance. You do not take money from investors and you avoid taking large loans from banks. This is how companies like Alux were built. The focus is strictly on profitability from day one, rather than artificial growth. The growth is slower because you are limited by your own cash flow. But the foundation is often much more solid. The reward for this struggle is absolute control. You answer to no one but yourself and your customers, keeping all profits. So, which path is right for you? It depends on your speed, your risk tolerance, and how much control you value. If you want to grow fast and dominate a market, equity might be necessary. If you have assets, debt is cheaper. High-growth tech startups almost always choose equity because they need to burn cash to capture market share before making profits. Real estate and manufacturing businesses often prefer debt because they have physical assets to collateralize and need to protect ownership. Lifestyle businesses and service agencies often bootstrap, prioritizing a healthy income and freedom over becoming a billion-dollar unicorn company. Every choice has a cost. Equity costs you ownership. Debt costs you interest and risk. Bootstrapping costs you time and speed. Understanding these mechanisms is what separates the average business owner from the true financial architect of a business empire. Your funding strategy should align with your ultimate vision. Do not just take money because it is offered to you. Sometimes, saying no to an investor is the best decision you can make to preserve the soul of your company. Evaluate the risks carefully. Leverage can make you rich, but it can also wipe you out if the market turns. In turbulent economic times, those with less debt and more control are often the ones who survive the storm. Building a resilient financial structure is just as important as building a great product or offering a great service. So, look at that pie again. Does it look better to eat it all yourself or share it with others? There is no single right answer. There is only the answer that fits your personal goals and your business model. Whether you choose the rocket ship of equity, the leverage of debt, or the freedom of bootstrapping, build with purpose. Document your journey, learn from the giants like Jobs and Apple, and make the choice that secures your legacy. Finance is the language of business. Mastering this language gives you the power to shape your destiny and your wealth. Keep your eyes open for opportunities. The right capital at the right time can change the trajectory of your life, even if you start with nothing. Bootstrapping proves that determination and smart reinvestment can build mountains from mere dust particles. And if you have a world-changing idea, do not be afraid to sell equity to get the resources you need. Respect the power of debt. Use it as a tool to amplify your returns, never as a crutch for losses. Business is a puzzle. Financing is simply finding the missing pieces to complete the picture you have in your mind. In this macroeconomic environment, money is abundant. It flows to those who know how to manage and multiply it. You are the captain of your ship. The capital you choose is the wind in your sails. Choose your direction. Every signature matters. Ensure you read the fine print and understand the long-term implications of every dollar you accept. Balance is key. Too much debt kills you. Too much equity loss fires you. Bootstrapping too long might starve you. Your goal is to build a stairway to wealth. Use the bricks available to you, whether borrowed or earned. Just like a farmer needs seeds and rain, a business needs capital and strategy. Ensure you have plenty of both. Forge your company in the fire of discipline. Whether you owe the bank or shareholders, deliver results with excellence. Let your vision be your compass. Do not let investors or lenders steer you off course from your true mission. When finance, operations, and vision align, the machinery of your business will run smoothly and generate massive value for you. Nurture your capital. Treat every dollar as an employee that needs to work hard for you to bring more friends. The road to financial freedom is paved with these decisions. Make them wisely and enjoy the ride to the top. We live in a connected world where capital can flow from anywhere. Be the destination that capital wants to visit. Plan your exit strategy or your dynasty. Know if you're building to sell or building to keep forever. One small financial decision today can ripple out and create waves of prosperity or tsunami of debt years later. Use data, not just intuition. The numbers will tell you if you can afford that loan or need that investor. Ultimately, you are building a legacy. Choose the financing that ensures your company outlasts you and continues to thrive. Study the history of business. The patterns of equity and debt have repeated for centuries. Learn from the past. Be the lighthouse for your team. Financial stability provides the light that guides your employees through the dark, uncertain times. Success is worth celebrating. But remember, the morning after the party, the bills must still be paid on time. Keep a clear mind. Do not let greed for quick cash cloud your judgment about what is best for the company. Your investors and the lenders are partners in your colony. Treat them with respect, and they will help you build. The world is full of capital looking for a home. Make your business the most attractive home for that money. Take action. Analysis. Paralysis is the enemy. Once you have weighed the pros and cons, make the move confidently. Business is a marathon, not a sprint. Structure your finances to last the distance, not just for a quick start. Protect what you build. Ensure your financing structure does not expose your personal assets to necessary corporate risks. Sow your seeds wisely. Every percentage of equity given away is a seed that will grow in someone else's garden. Let your revenue flow like a river. Strong cash flow is the ultimate cure for most business financing problems. Financing is the final piece of the puzzle. When it fits, the picture of your success becomes clear to everyone. Fly high and see the big picture. Do not get trapped in the weeds of daily struggles. Look at the horizon. Celebrate your partnerships. Whether with a bank or an angel investor, good relationships are worth more than gold. The market is always moving. Stay agile. Be ready to pivot your financing strategy as the economic climate changes. You are the author of this story. Do not let the bank or the investors write the ending for you. Keep the fire burning. Sustainable growth is often better than a sudden explosion that burns out just as quickly. Reaching the summit is hard, but the view from the top, with full control of your destiny, is priceless. Imagine the life you want to lead. Let that vision dictate whether you take the loan or sell the shares. Capital is just a key. It unlocks the door, but you still have to walk through and do the work. In the digital age, the rules are changing, but the fundamentals of ownership and debt remain exactly the same. The ocean of opportunity is vast. Do not be afraid to set sail, but ensure your boat is watertight first. Time is your most valuable asset. If money can buy you time to grow, then it is a worthy trade. Build bridges, not walls. Use finance to connect your present reality with your future dreams and aspirations. Your story inspires others. Make sure it is a story of smart decisions, calculated risks, and well-earned rewards. There are infinite ways to win. Do not copy someone else's path just because it worked for them. Do not gamble with your company. Make calculated bets where the odds are shifted in your favor by knowledge. Build for the future. The decisions you make today about equity and debt will echo for decades to come. We hope this breakdown has given you the clarity needed to navigate the complex waters of corporate finance. From the bakery to the boardroom, from Steve Jobs to Apple's bonds, the principles of money never change. If you found value in this video, please smash that like button and subscribe to our channel for more. Thank you for watching Macro Money Talk. Choose your funding path wisely and subscribe for more insights into building your empire.